I know a lot of you are feeling uneasy about the markets right now, and the economy can feel a little out of control at times. There's a lot of noise and a lot of opinions. But before you try to react to any of that, we need to take a step back. Current events are just that. They're current today, but fleeting tomorrow. Just like trends, whether it's in the market or in fashion, they change. But when you understand the structure behind the system, you can build a financial strategy that is timeless and resilient. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist and the owner of Diamond Point Financial. Each week on Pointe Perspective, we step inside the analytical process behind financial decision making, breaking down how professional investors build strategies, interpret economic systems, and align financial decisions with the life you're trying to create. This week, we're focusing on 3 foundational pieces. First, we've seen increased volatility in the markets, so we'll walk through what it means to build a strategic portfolio based on your goals and your personal situation. Second, we'll step back and simplify something most people use every day but rarely understand. We're discussing what money actually is, how it's created, and how it operates in the broader economic system. And lastly, we'll bring it back to you and your financial planning, starting the conversation around retirement and why it should begin with a clear vision, not just a number. Because financial strategy isn't about reacting in the moment. It's about building something intentional and understanding the structure it's designed to support. With all the volatility over the last few weeks, we've talked a lot about building an intentional portfolio. But what does that actually look like in practice? You have to consider factors like the purpose of the funds, your time horizon, and your personal relationship with risk. These elements fit together like an equation, and depending on what you plug in, your outcome can look very different. So before you ever build a portfolio, the first question you need to answer is, what is this money for? Too many people jump straight into investments. I see this all the time on social media. What stocks should I buy? What funds should I own? Or people asking others where they have their money without even knowing if their situations are similar. Professional investors don't start there. We start with purpose. Is this money for retirement? Is it for a home purchase in the next few years? Is it for long-term wealth building or short-term liquidity? Because the way you invest that money should look completely different depending on its role. 2 people can have the same amount of money and need completely different strategies. Their timelines are different, their income needs are different, their goals are different, and their tolerance for volatility is different. A 35-year-old building long-term wealth will invest very differently than someone 5 years from retirement who needs income soon. A taxable account is going to be built very different than something that in a tax shelter, like a retirement account or an annuity. That's why copying someone else's portfolio, even if it looks successful, can introduce unnecessary risk if it doesn't match your plan. Now, once you understand the purpose, the next step is defining your time horizon. When will you actually need access to those funds? Historically, the longer your time horizon, the more likely markets are to average out that volatility. When we look at rolling periods in the stock market, 1-year returns can vary widely, both in the positive and the negative. But when you zoom out to 10 or 20-year periods, outcomes have typically been more consistent. Even a 5-year window can provide a meaningful recovery period depending on where we are in the cycle. Of course, that doesn't mean risk disappears, but your perspective is different. If you need the money in 2 to 3 years, a market downturn can directly impact your plan. If your timeline is 15 or 20 years, that same downturn is often just a piece of the larger system. So before choosing investments, you have to define your time frame and determine whether your plan can absorb fluctuations and allow for recovery. That's what ultimately determines how much risk and volatility you can afford to take on. And when it comes to risk, it's important to understand your risk tolerance is not what you say. It's how you behave. It's easy to feel comfortable with risk when the markets are stable, but behavior tends to change when markets decline. During corrections, we often see increased selling, hesitation to invest, and emotional decision-making. That's also why we separate risk tolerance from risk capacity. Risk tolerance is what you feel comfortable with, but risk capacity is what your financial situation can actually support. So for example, someone with a long time horizon, stable income, and a strong savings may have a high capacity for risk, But if they panic during a 10% decline, their tolerance may be lower than they expected. An effective portfolio has to account for both, because abandoning the plan at the wrong time can be far more damaging than the volatility itself. Once that structure is in place and we've answered how much risk should be taken, how much liquidity is needed, and how much growth is needed over time, then we can start to choose the investments that fit within it. And that's where diversification comes in. Diversification is not about owning more of everything. It is possible to be over-diversified in a way that limits your growth. Diversification is more about owning the right mix of assets for your specific plan. At a basic level, diversification means spreading your investments across different asset classes that all respond differently to economic growth, interest rates, inflation, and market cycles. So instead of relying on one outcome, you build a portfolio that can adapt across different environments. Next week, we'll break this down in more detail. I'll walk through the most common asset classes, how they behave, and how they work together inside a portfolio. With Pointe Perspective, we've talked a lot about the economic system, and over the next few weeks, we're going to take those topics a step further, this time focusing on money. Most people use money every single day, but very few people actually understand what it is, how it's valued, or how it's created. Despite what you might think, at its core, money is not wealth. It is a tool. It's a system we use to store value, measure value, and exchange value across the economy. In economics, money serves three primary functions. It's a medium of exchange, allowing transactions to occur efficiently. It's a store of value, allowing purchasing power to be carried over time. And it's a unit of account, giving us a consistent way to measure and compare prices. That's the foundation of the system. So what gives money its value? It isn't gold and it isn't scarcity in the traditional sense. It's trust and structure. Modern currencies are what we call fiat currency, which means they are not backed by physical commodity, but instead by government authority and the strength of the economic system behind them. That value is maintained because people are willing to accept it in exchange, and because the system reinforces that acceptance through taxation, regulation, and policy. Now, money is not static. It expands and contracts over time. Yes, central banks can increase the monetary base through actions like printing currency or purchasing assets, but most money in the system is not created this way. It's created through credit expansion. When banks issue loans, they're not simply transferring existing money. They create new deposits. And that loan becomes spending power for the borrower, which increases the total amount of money circulating in the economy. This is part of what's known as the fractional reserve banking system. Now, if you've watched our previous discussions, you already understand inflation and interest rates. So let's take that one step further. As lending increases, the money supply increases. And when the money supply grows faster than the production of goods and services, we begin to see upward pressure on prices. That's one of the fundamental drivers of inflation. This is also why interest rates matter so much. Higher interest rates tend to slow borrowing and money creation. Lower rates tend to encourage borrowing and expand liquidity in the system. Like everything else we've discussed about the economy, it's not just about output or employment. It's a system where money, credit, and behavior are all interacting at the same time. Money isn't just something you earn. It might feel stable on the surface, but the system behind it is constantly adjusting. Understanding that system is what helps explain many of the economic shifts we experience over time. When most people think about retirement, they immediately think about a number. How much do I need? Will I run out of money? And while those are valid questions, they're incomplete. It's the same thing when I hear people say you need $2 million to retire, or that you should follow the 4% rule. Those are general guidelines, but they are not goals. And there's no reason to assume they should apply to you. Retirement planning shouldn't start with a number, it should start with a vision. Too many people sit in my office and say, I just don't want to run out of money. And I get that. It's a very real and very valid concern. But it is not a plan. The real question is, what do you want your life to look like in retirement? Retirement is more than just not working. It's about how you want to spend your time, your energy, and your freedom. Now for me, I already have a clear picture of what I want retirement to look like. It may evolve over time, but the foundation is there. I want cross-country trips with my grandkids, projects that keep us both engaged, physically and mentally. My husband wants to spend time working on cars, whatever that may look like. And I know by nature, we're not the type of people who will just sit still. We'll always be doing something, but not necessarily something we have to depend on. Now, your version of retirement doesn't need to look anything like mine, but you should have a vision. It's what gives your plan direction. Then, as retirement gets closer, that vision will become even more refined. I'm going to suggest a little homework. If you're married, try this individually first and then get together. Ask yourself a few questions. First, how much income will you actually need? What expenses will go away and what new ones might show up? And let me caution you here because I have been doing this a long time. Please don't assume your spending will be lower in retirement because it rarely is. Next, think about what you want your days to be focused on. Will you travel or be more heavily involved with your family? Maybe both. Then think about something that may seem obvious, but you'd be surprised. Where do you want to live? Do you want to move or maybe downsize? I'm even seeing a lot more clients considering living internationally. And finally, what kind of lifestyle do you want to maintain? Do you prefer a slower pace or do you like to stay active and on the go? Because your day-to-day life should reflect your values and your habits. Planning like this creates structure and gives you something to look forward to. It creates a target that's personal and aspirational. Retirement planning shouldn't feel like you're checking a box. It should feel meaningful. And lastly, one more thing I'll add. If you are in your 30s or 40s today, retirement is going to look different than it did in previous generations. We're living longer, healthcare costs are rising. So instead of focusing only on when you can stop working, think more about how you might transition. Maybe that means working longer, but it's on your own terms. Maybe it's part-time, less stressful, or in a field you genuinely enjoy. One thing I would caution against is getting stuck in extremes. Some people are so focused on enjoying today that they never plan for the future. Others are so focused on retirement that they sacrifice too much in the present. Both create imbalance. That's why strategic retirement planning requires perspective. Let's build a vision that allows you to enjoy the journey, not just the destination. Today we talked about how to build a portfolio with intention. We broke down what money really is, how it's created and how it moves through the system, and we started to reframe retirement, not just as a number to reach, but as a life by design. And when you look at all of that together, it really comes down to one thing: understanding what you can control and what you can't. You can't control the markets. You can't control interest rates, inflation, or geopolitical events. Those things will move, shift, and evolve over time. But you can control how your portfolio is built, your time horizon, and your exposure to risk. And most importantly, you can control whether your financial plan is aligned with the life you are trying to create. That's where real financial confidence comes from. Not from predicting what happens next, but from knowing that your plan is built to handle it. Next week, we'll continue building on this. We'll take a deeper look at asset allocation and how to structure a diversified portfolio. We'll continue the retirement conversation, focusing on account types and tax strategy, and we'll expand on money, looking at banks and their role within the economic system. If this helped you see things a little more clearly, make sure you subscribe so you don't miss future episodes of Pointe Perspective, where we continue breaking down the markets, the economy, and the thinking behind strategic financial planning. And if you have any questions about your own situation, you can always reach out using the contact information below. I hope this added some useful perspective, so until next week, take care.